two super investors that have amazing track records have come out and doubled down on their negative outlook on markets and the economy. We have new warnings from Jeremy Grantham and Michael Burry. And in today's video, I'm going to walk through exactly what they said so that you can prepare yourself for what's coming up next. If you're new to my channel, my name is Larry, and I talk about US and China investment strategy. Outside of YouTube, I also am on Twitter, Instagram, and Substack, where you should definitely join me because I have a lot more time to post on those platforms frequently. Now, we're going to dive into the warnings that Michael Burry and Jeremy Grantham have said recently. And the reason that we should pay attention is that they have had a powerful track record in calling the 2021 bubble burst that has since happened. So let's take a look at what Michael Burry said at the beginning of January in a now deleted tweet. He said that we are likely to see the CPI index lower, possibly even negative in the second half of 2023. And the US will be in recession by any definition. The Fed will cut, the government will stimulate, and we will have another inflation spike. It's not that hard. In other words, he's essentially saying the Fed does not have the political willpower to hold rates at where they say they will hold rates, and therefore will start prematurely cutting, and then therefore letting the inflation genie out of the bottle, causing Armageddon and chaos down the road. Now, Jeremy Grantham has come out with a new investment letter called After a Timeout, Back to the Meat Grinder. And in this 10-page report, which I'm going to summarize for you, he shares a couple viewpoints that walk through why he believes the worst is yet to come for markets. So here are some of Jeremy's main ideas. He first says that the easiest leg of the bubble has popped and is now complete. So he believes that while the bear market will continue, the timing and the magnitude of it will be a little bit more uncertain than where it was last year, where he called it with an absolute certainty. This is because he sees the current presidential cycle, which I will show you the data on in a minute, the very strong labor market, falling inflation, and China's reopening as potential factors for softening a stance on the timing of the bear market accelerating. But he sees that housing and the decline in housing going to have a more powerful knock-on effect because a lot of the middle-class wealth is tied in housing. So his conclusion is that the S&P 500 most likely trades around 3,200, and there's a potential for an overshoot underneath this target if there is excessive fear. So let me show you the data, the tables, and the graphs that he put together in his letter to help you save time and understand how he expects markets to play out. So one of the reasons Jeremy Grantham believes that the bear market's timing is not going to be as precise as the first stage of the bubble popping is the presidential cycle in this table here. So we can see from this chart that from October 1st of year 2 in the presidential cycle to April 30th, the returns of the US stock market, they tend to be stronger than the rest of the other periods of the cycle. For this reason, there is historical data that makes a case for equities being supported in the near term, in the next couple months. Now, one of the reasons that he believes that a recession is inevitable is that the yield curve has inverted, and it has inverted sharply. We can take a look at the 10-year minus 3-month US Treasury, and this yield curve inversion has almost preceded every single recession as reported by the NBER. Now, he also sees that the stimulus cash from the COVID-19 stimulus, the 2020 era, being used up largely this year. A lot of analysts have said that the peak of excess savings, it was about 2 to 3 trillion in late 2021. But a lot of that was drawn down through 2022 as people used up their savings. And in 2023, he expects this balance to be drawn down even lower. And that means that retail investors will have less money to buy the dips, and they will have less confidence to invest in a volatile market. Jeremy Grantham also has done data analysis on what has happened to markets after rate cuts. And contrary to most investor expectations, Usually, after rate cuts, the market has actually fallen quite substantially. And the table here displays historical data from 1929, 1974, 2000, and 2007. So because of this, his investment firm, GMO, they've got a long-term gloomy forecast. We can see here that their forecast for US large and small cap stocks is actually negative over a 7-year forecast. Now, this does not mean that there won't be multi-month rallies. For those of you who are familiar with my investment style, I focus on the intermediate term, that 6 to 9 month sweet spot. And in those 6 to 9 month timeframes, there will be, of course, vicious bear market rallies countered with like large sell-offs. So this 7-year forecast implies that if you were to put money in today and wake up 7 years later, the returns are most likely going to be disappointing. But in between, there's going to be a lot of opportunity. Now, his investment firm sees a lot of opportunity in emerging markets, especially the value stocks in emerging markets. And also, he sees bonds being priced more attractively than US equities. Now let's dig a little bit deeper into the economic data that people sometimes gloss over, into the labor market. Out of all the jobs that have been created since February 2020, most of them have been created by small businesses. It may surprise you that larger businesses, companies with 250 employees or more, they've actually cut 800,000 jobs since that period of time. We can see from this chart here that large companies, companies with 250 employees or more, they're actually hiring at a much slower rate than small businesses. But the problem with this chart implies that when there is a recession, small businesses, they scale back on their hiring much more rapidly than large companies. Other economic data points includes retail sales falling 1% in December. This is really important because if we take a look at a longer term chart of US retail sales, this may mark the peak of consumer consumption, and that may mark the beginning of a large consumer recession that Jeremy Grantham and Michael Burry are calling for. Employers, they're shedding a lot of temporary workers at a fast rate, and this is a sign that broader job losses could be on the horizon. If we take a look at this chart here, month over month over month, we're seeing temporary jobs start to get cut from the labor market. Now I want to bring your attention to geopolitics, which ironically could support US markets in the near term. Let's take a look here. Saudi Arabia, they say that they're open to settling trade in other currencies. Now on the surface, this is negative for the US dollar because that means that the Saudis are now open to using the Chinese yuan or possibly the euro to settle oil transactions. And that is something that is likely to upset US politicians because there was an agreement back in 1973 for the petrodollar where the US agreed to offer armed protection to Saudi Arabia, and it also provided weaponry and other military supplies in an agreement involving the overall sale of oil in only US dollars. And because of this, Saudi Arabia would recycle the surplus dollars into the American economic system using US Treasury bills. Now, discussions from Saudi Arabia with China on using the Chinese yuan or other currencies to transact for oil, those discussions started happening in fall of 2022. And we can see here that the dollar has weakened substantially since that time. Now, of course, there's also narratives about the Fed not being as hawkish in 2023 to support the dollar weakening, but that combined with the petrodollar being dethroned has made the dollar weaken significantly. Now, this is potentially supportive for Fortune 500 companies, the S&P 500 companies, because these companies have a lot of operations internationally, and a weak dollar could be a tailwind for these companies' sales and profits later this year. So the irony here is that while the geopolitics are likely to frustrate politicians, this is indirectly beneficial for US stocks in the near term. Now let's take a look at China's reopening, where the recent Lunar New Year has seen an uptick in tourism bookings, travel transactions and hotel bookings as well, and consumer consumption has been strong. This bodes well for China's longer-term macro story, something to pay attention to, but it's also important to realize that China has run up significantly since the fall. So a little bit of caution here is expected. Now I want to provide some commentary from my investment community on the latest earnings season. Let's take a look at Netflix here. I want to show you a chart of Netflix and some of their revenue and subscriber growth figures so that you can understand the consumer indirectly. Some commentary that I provided inside my community include the following. We're seeing the ARPU, which is the average revenue per user, being steady in North America. But outside of North America, ARPU, average revenue per user, in Europe, in Latin America, in Asia Pacific, they're either flat or they're falling. And also for North America, we're seeing that Netflix is having fewer paid memberships than they did in the fourth quarter of 2021 when compared to the fourth quarter of 2022. So year over year, Netflix paid subs have actually decreased. And much of the subscriber growth has come from their cheaper ad-supported tier. Fundamentally, this means that Netflix's gross margins are coming down and their subscriber recovery is coming from a lower average selling price tier. So net-net, I think that this tells us that the consumer is not necessarily that healthy and we need to be on watch for further consumer signals later this year. Now, I do have some good news for you, and this is a chart from JP Morgan where they asked their institutional investors, are you likely to increase or decrease your equity exposure in the near term? And we can see that from this chart here, there is a very small percentage of people planning to increase their equity exposure. And what this implies is that positioning, generally speaking, is very, very conservative. It's very light. So that means any upside surprise at all with corporate earnings, with economic data, it could change people's sentiment very quickly as people rush to FOMO into the market. Now, I don't think that FOMOing into the market is a good idea, but it also means that there is still a little bit more upside left before the bear market resumes its trajectory, like Michael Burry and Jeremy Grantham says. With that said, guys, make sure to join my email list down below for further insights, commentary, strategy. I give lots of exclusive research and previews, and I will see you guys in my next video.